What is going on, everybody? So we're just going to jump straight into this per usual. So we're looking at the ES right now, which is an S&P 500's futures contract. And we talked a little bit yesterday about how we thought the market was just going to kind of continue to trend higher intraday. And it pretty much did that. Actually, half of the move was really pre-market. And then the rest of the day was just kind of consolidating near the highs, which for the S&P 500, this is around 5K, basically at 5K. We talked about how that would be a very significant level. What I didn't mention, though, is another reason why that's such a significant level, which is that a lot of option market makers are going to be doing a lot of shuffling, buying and selling things as you approach that level and as you get away from that level. And it kind of acts like a magnet because of how these market makers run these different strategies. So 5K is likely to be a very sticky level. And based off the reaction yesterday, this is how I'm seeing it. Pretty much what we talked about, but I want to add that I think there's a good chance we could break above it temporarily. But if we do break above it, I don't think we're going to close above it. There is a reason for this on the lower time frame, apart from we talked about how a lot of people would sell there. We have CPI next week, and although I don't really think it's going to be that big of a game changer for the markets, it's something that, let's say that you had a big long open, and then that CPI were to come in significantly hotter or even just hotter, you probably wouldn't be happy about that. So I do think you're going to start to see some hedging for that. Oftentimes, you don't really see aggressive hedging until right up until the event. So I'm not saying that's going to happen this week. In terms of the economic calendar, today there's really nothing. So this is kind of a perfect situation, really, for the stock market intraday from a day trading perspective, while the momentum is obviously up. It just happens to be that you're at 5K, so I'm not really leaning towards longs necessarily unless we get closer to this 49.95, 49.80 roughly. I want to see absorption. I want to see the order flow as we get closer to this zone. Closer to this zone. And then I would probably take some longs off of that. If, vice versa, if we get closer to this 50-20 level, which is for the S&P 500, that's basically 5,000, I would be looking to short really on any kind of absorption or any kind of signal there, because risk reward is really favoring the bears here in the short term. Although things are very bullish still, it's just from a purely risk reward standpoint. You clearly see people that are FOMOing in to this market. And the question that you have to start asking yourself, or at least what I'm asking myself, is how much more FOMO can we really get here before another round of pullback and go higher? Because part of the reason why we've been moving so aggressively over the last few weeks is because of trading psychology. So we talked about how yesterday markets are very reflexive. And as the prices go up, this has an effect on people's brains. This is why computers are interesting, going to be very interesting for trading as we go further in the future. But that's a little side note maybe for another day. But humans have this tendency to change their view of reality based off of the profits or losses they're making. So, for example, you see this in crypto. It's hilarious where everybody's like, oh, yeah, man, I love the tech. I love crypto. It's awesome while it's going up. The minute it starts to go down, specifically when it's gets aggressive to the downside, it's I don't really think it's that useful anymore. I don't really see the use case in it. And it just did anything really change? Did the fundamentals of crypto really change when the prices went down for the most part? No. So this is really just goes to show you that a big part of markets moving and momentum is it's reflexive positive feedback price action because of how human beings are wired. So a logical trader would sit here and say, okay, why are we really moving this aggressively? Now, there are reasons. We talked about how global liquidity is trending higher. We talked about how if earnings came in good, that this would be very supportive of a market that, again, has global liquidity going up, meaning the ammo is there, right? We just needed earnings to do well and Jerome Powell not to throw water on the fire, which you can make the case that maybe he tried to, but it didn't work. Earnings were good. Liquidity is still looking good. But I think, again, from just a pure trading standpoint, you have to start looking at this situation as, in the short term, expecting a pullback. Okay, we could go into that again. We talked about it last video, But what could be some of the actual macro factors that could actually cause a pullback right now? Because I actually don't think the market in its current form, meaning in steady state, assuming that the conditions and variables stay constant, which they never do, but just, for this hypothetical conversation, assuming they stay constant for the next little while, you probably won't get a big pullback. The reason is, although I'm talking about the market having all this FOMO and they really are worried about not participating in this market, specifically AI. That's what's really driving the market up right now, these tech stocks associated with AI. And it's pretty clear that the markets, or let me just say this, there are people on Wall Street, and we talked about this months ago, how as we started to go up, that would cause a lot of people on Wall Street to have some FOMO. Why? Because the last 2 to 3 years, they probably didn't do that well. Why? Because most stocks have been going sideways. Although the S&P 500 has been going up, the NASDAQ has been going up because of AI, really. For the most part, most stocks have been going sideways, which means unless the hedge fund or whatever investment group, trading firm, unless they just bought the S&P 500 or the NASDAQ or just bought the 7 stocks that have really been driving this market, they probably underperformed it. Why does that matter? Because as we go into this year, they're probably thinking to themselves, coming together, some of these guys saying, look, we aren't about to, underperform the NASDAQ or the S&P 500 again. That's not going to happen this year. What we're going to do is we're going to be aggressive. And although, if we buy things, it goes down, we'll just add more. This is what's going on right now. It's a lot of people realize they better get into this market before it gets away from them. It just happens to be that I think this is probably not the best time to do that on a lower time frame. Now, on the grand scheme of things, assuming that global liquidity keeps trending higher, that the treasury market, repo market doesn't explode, then you're probably not going to be upset that you bought here, but you might be in the short term. So basically what I'm trying to get at is a big part of this move here is FOMO. It's the fear of missing out, not participating in a lot of these explosive gains. And some people are saying, look, I don't care if the market goes down. I just want to be in it. Okay. That usually leads to some kind of local top, in my opinion. Doesn't mean this is a local top, but starting to get those signs, okay? And I was talking about how, I'm talking about how the treasury market, repo market, how that's important. You know that we had an issue from like June to about November of last year with the bond market. And we know that bonds are used as collateral for bigger institutions. And this was a problem. And this actually had a big effect on the market as this collateral, as the term premium basically started to become unfavorable, which, this is bond jargon stuff, but basically the bonds weren't as safe because of the volatility. They weren't able to borrow as much. Their margin decreased. Well, this is problematic for global liquidity. So we had that pullback. The reason I'm mentioning it now is anything that is related to that you want to start to pay attention to, right? Because we know that the market is very sensitive to that kind of stuff. Well, we have this bank. If you don't know what it is, it's New York Common. I forget what the B stands for, but it's some bank, and it's a regional bank, and it's having an issue that is similar to what happened to Silicon Valley Bank back in March of 2023. We know how that affected the markets. There was a pretty sizable pullback, especially in crypto, and then the Fed created the BTFP program. So I think it's important to mention this because it's very similar, but the difference here is it seems to not be it's not really affecting the market. So we can see that volatility, implied volatility, the reaction to the banks having issue back in April or March rather. You can see here if I zoom in, this was when the Silicon Valley Bank crisis happened, if you want to call it a crisis, and these are when a couple of other banks had some issues, Pacific West and I forget what this one's called. Well, look at here. So these are the two banks, NYCB and Ozora. I'm not even sure what that is, but two regional banks having issues. Volatility is not increasing. So what this means is the market has kind of learned this is probably not that big of a deal because the Fed will come to the rescue. That's my interpretation, but I present this to you because I think it's something to pay attention to. You don't want to see a lot of these banks having problems. But again, the market looks like it's just brushing it off, and probably for good reason. Because that bank term funding program can probably be extended, worst case. I think that's what the market's probably thinking. What else we want to talk about here? One thing I do want to talk about today is gold. Okay, I'm going to zoom out here, and then we'll finish with crypto. Talk a little bit about some commodities here. We made some videos on gold back in, I think it was a few months ago. We were talking about how gold is really one of the best trades, maybe the best trade, depending on where you are in life, how conservative versus how aggressive you are. But I think it's time to kind of come back and look at this, because I think this is about to complete a major accumulation that has occurred since really 2020 till now. So you're talking about almost 1,300 days of accumulation. And what that tells me is this thing is really getting set for a very explosive move. Doesn't mean that it can't come all the way back to some of these levels it's came to earlier. In fact, I think that's probably, if we do get a pullback in liquidity, that's probably likely. But I think you're risking about 10%. I don't think you would make a new low. I think maybe more like 5%. And the upside on this, I don't think I can even really put an upside on it other than a lot higher. I think the first stop is 2,400, but I'm talking about over the next 5 years, you could see this thing double. That's not a ridiculous statement. And the reason I say 5 years, so 5 to 6, 7 years. If you look at, and I should have brought this up, but if you look at the U.S. debt, okay, and this really, we should make a whole video on this because it really is an interesting subject, and you can only come away with a couple of conclusions. But the only conclusions, or let me just say this, the conclusion that I have come away with when I see the U.S. debt situation and what that really means in terms of how the Fed has to operate, meaning putting things on the balance sheet, the conclusion I come away with is that gold and Bitcoin disproportionately benefit from this. And I think Bitcoin disproportionately benefits from it versus gold. However, I realize that some people aren't accustomed to Bitcoin. They don't understand it. They may be older. So gold is actually a pretty good option. I think it's the second best option. And also, some stocks. Now, I guess the question that people should really have here is, what doesn't benefit, right, from this expansion and liquidity that is really going to be driven by the United States government needing to print money to service all of its obligations? What doesn't benefit from that? And in terms of risk assets, almost everything benefits from that, assuming that the economy is doing well, assuming that earnings are doing well. So this is kind of the difference why I say that stocks are a little bit of a question mark as you go past the next couple of years, whereas with gold and Bitcoin, doesn't care about earnings, at least in theory. Obviously people's balance sheets could be reduced as earnings go down. They may not have as much money to put into gold or Bitcoin, but really it is, I'm not going to say immune, but somewhat going to be immune from that. I think people will see it as a flight to safety. And I'm not talking about crypto in general. I'm really just talking about Bitcoin here. And you can make the case Ethereum over time, but we're just not there yet with that asset. So I'm putting this on the radar because I think that this is really the time to buy gold. I mean, not that it wasn't the time to buy it here. It's been the time to buy gold for a long time now, but especially now, because I think that the big kind of aha moment for the average Wall Street person that's moving a lot of capital is that the easiest trade at this point is anything that disproportionately benefits from monetary inflation. Not CPI inflation. Those are two different things. Monetary inflation. Because it's the only variable that, if you look at it, is literally almost guaranteed. I mean, I would say guaranteed to go up. It can't go, either the United States government completely implodes or they have to print money. I mean, there's really no other way to do it. And I shouldn't laugh, but it is a very interesting situation that we're in, where this becomes a positive feedback loop that just creates more debt. That debt ends up creating more debt, and it just goes parabolic. And this is why when people say, Bitcoin to $1 million, you should probably bump that up a little bit, assuming that this debt situation continues on track through 2030. It may take 2 decades, but it's going there. And this is going to be because it's not that necessarily that Bitcoin's going up versus other things. although I think it will, but it's definitely going to be going up versus a currency that is being inflated, right? So people will be talking about this when gold is way up here, okay? Talking about it when gold's way here. Good to talk about it now before it leaves this ginormous accumulation zone that it's in right now. You're still in this range. So you're still kind of early before this thing really starts to take off, in my opinion. Now, let's take a look at gold. I'm sorry, Bitcoin. So Bitcoin had a really nice reaction since the video we made yesterday. We see that, let's just go kind of through this real quick. We talked about how I had this move down below 40K, had a little nice accumulation here, and then boom, off the races. This doesn't surprise me at all, to be honest. It doesn't surprise me it dipped, doesn't surprise me that it's rebounded. It won't surprise me if it comes back down and ranges sideways either. But the thing about the Bitcoin trade is you just have to wait. It's the easiest trade, in my opinion, that I've ever seen, really, because, again, it almost cannot go down in this environment. And I hate to say that because I know that sounds ridiculous. And you should never just assume something like that most of the time in trading. But this is like the one exception almost to that where it almost can't go down very much in this environment, right? Now, if something happens where the United States government decides that, you know what, we're going to spend way less money, we're going to cut a bunch of welfare entitlements and Social Security, well, then that might actually change the trajectory of this. But assuming that the same politicians are in office, and I hate to get political here, but this thing is just going to go up because there's only 21 million Bitcoin, your houses will go up. Anything that is scarce can almost only go up in an environment like that versus the dollar, right? Bitcoiners have been saying this for a long time, but it's very true. So I think that the world is going to start to realize that more and more and more, that the only way they really play this kind of environment that we're in, which is late stage Fed, and who knows, maybe we have 50, 100 more years of this, but the only way to play it is to buy things that disproportionately benefit from it. Gold, crypto, there's other things too. So what I'm saying is if this is so obvious to me and I'm here ranting about it at 8 o'clock in the morning, I'm sure there's some people with very large, people who have a lot of capital that also realize this too. And it's good to get in before they do. So I think this is still very early for Bitcoin. So if we look at ETH, similar situation. We're talking about the narrative there for Bitcoin that's going to be going on for a long time. ETH has kind of a different situation, right? So ETH is not really necessarily a store of value, although I would say it is. It's deflationary at times, but at least it's disinflationary almost all of the time, or at least break even, net issuance of zero. So I think it disproportionately benefits from this kind of narrative as well, but it also has kind of this like tech growth kind of vibe to it as well, where I could see it maybe decoupling at some point from Bitcoin, depending on how people view it. But that hasn't happened yet. But I'm saying Bitcoin doesn't have a lot of upgrades. There's not a lot of things to really price in that we do not know now. Or there's less things. For ETH, there's upgrades, there's things being built on top of it, there's adoption here, there, blah. And not to say that there's not some of that on Bitcoin, but it's way more, the magnitude is way greater, far greater for Ethereum or something like Solana, which is having a nice move up here from the low. These are just kind of different things, and I think that they will eventually trade differently than Bitcoin. Okay, so one other thing I want to show you guys today is just a few altcoins that I'm going to show you these altcoins because I'm realizing no one else is going to show them to you because they're looking at things that are bright and shiny today. This is more of a longer term discussion here, but I want to show you a few coins that I think it makes just no sense in my mind. Like there's an asymmetrical opportunity given enough time has passed with some of these crypto projects. One of them, okay, is Aave. So if we look at Aave here, it's been in this range now for roughly 600 days. So this is a accumulation range. So we had this huge move in 2021, ended up getting topped out roughly about 600, depending on where you want to take the at the top here, but somewhere in, 550, 600 area. Okay. So as of right now, today, assuming you take that roughly $600 area, you're down 85%. Okay. Go look at a lot of tech stocks in the 90s and see what they did. Very similar. You're in this accumulation range. Once you break out of this, it's going to get explosive. So that's the technicals. Well, what about the fundamentals? Aave, in terms of the last 7 days, is averaging about $450,000 in fees per day. So yesterday they had about $470,000 in fees. Why am I showing you this? Because this is one of the weirdest things about crypto is how inefficient it is. Everyone's looking at all these different things. They're investing in things that have no use case, no users. But the real money that comes into this space, that's really going to provide, that's going to really create the real ecosystem. They're going to start pouring money into things. They're not just going to go, oh, look at this thing that has no users, has no obvious, there's no obvious, benefits to me buying this other than it's just, I'm gambling. They're going to say, okay, what do we use in traditional finance to invest in things? Well, that's called fundamentals. And this is something crypto people don't understand. What are the fundamentals in crypto? It's not very difficult. Who or how many people are using the things? Are they generating money? That's the most important thing, meaning are people paying money to use it, right? And, there's a lot of other things we can get into, but that's the main thing. Are they generating fees? Why does that matter? That's called a business model. Right? You're generating fees, aka revenue, for the protocol. Well, who is generating revenue? Well, obviously Ethereum, so the proof of stake network, the fees. Bitcoin, there's also an incentive fee mechanism. So you're averaging about $3.6 million in fees per day. And then you get to the applications, which are interesting to me because almost no one's talking about them. Uniswap, huge. I mean, this is ridiculous. They're making like 1.5. And I'm not saying Uniswap the protocol, but $1.5 billion of revenue is being generated. Now, most of that goes to the LP providers or liquidity providers. Okay, I need to mention that, but it's still showing you it's still showing you what people value. They're willing to spend $1.5 million in fees per day. It's telling you something. It's telling you it has a demand, has a use case. Aave, right here, number 4. MakerDAO, okay, and Arbitrum, very interesting. They're actually generating a pretty good bit of fees here, right? Curve. And I'm not going to go too much into this, but I just want to show you, technically, super bullish, in my opinion. Accumulation, and then the fundamentals. If there is such thing as fundamentals in crypto, it has it. Curve, I just showed you those fees. It's almost at the bottom, literally. You want to see how far Curve is down from the highs? Roughly, let's say this is the top. Oh, well, Curve's down to 92%. Just saying, something's not right here. It's got a product that people are actually using to pay, they're paying to use a service disproportionately to other things that have a lot more attention. Why is that? Okay, we can talk about whether governance tokens actually have real value, blah, 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 blah. I have a whole thesis on that I'm willing to talk about maybe in another video. But I just want to put these things on your radar. Curve, Aave, Uniswap, DYDX, real products. People are using these things. They generate fees. And that is really the best way to approach the application layer of crypto, in my opinion. I think that's all we're going to talk about today, guys. Until next time, happy hunting, friends.
Hey, thanks for watching. Be sure to like and subscribe to our channel if you'd like more updates like this, and let us know in the comments, what do you think about today's video and Defiancy update and insight? Also, make sure that you join our Discord, our free community chat, where we discuss things like this, what's going on in real time. Typically, our Discord community is the first to know what's happening, and we would love to see you there. Check the link in the description. And until then, we'll see you in the next Defiancy Insight video. Bye for now.